Welcome to Subramani. The market has been sending mixed signals, and we have no clue how to handle it, right? So, what I'm trying to say is this a buy on dips market, or is this a sell on rallies market? This is a very common question which people ask, and many people also ask, should I stop my SIP? Should I buy more shares of, should I buy more units of the mutual funds which I have, which means I'm doing an SIP of 25-30,000 rupees per month. Should I add more to the same fund, or should I pick up an index fund? Now, none of these questions are easy to answer on the day that you're asking me the question. I can tell you perfectly correct answers only 6 months later or 5 years later. So then let us go to some of the biggies and see what solutions they have. For example, Jason Zweig, he talks about the market sending signals which mean different things at different points in time. Like when you're driving, let's go to where the signal word comes from. Red means stop, green means go, and amber means slow down, right? So that's how you look at it. Though many people look at amber and say, oh my god, I've got only 10 seconds to go, let me rush. So both those things are there, but normally this is what it means. Red at least means stop, and green means grow. In the market, it could be red means go, and green means stop at some times, and sometimes red means stop and green means go. So when you are not sure with how to read that signal, you get confused, and then you are again wondering what to do. For example, if you need money in a year or two, signals don't matter. You should get out of the market. Immaterial of whether the market goes up or goes down, it makes sense for you to get out of the market unless it's a flexible goal. For example, buying a car. Buying a car is a flexible goal. You don't have to buy it this year or next year. You can buy it whenever you want. It's not absolutely necessary to buy it exactly when the market is down or things like that. But paying your daughter's engineering fees has to happen the year she passes class 12, right? So there is no choice. Marriage, you don't know when it will happen, but you know it will happen in a range. But buying a car, buying a house, anything can be postponed, but school fees, college fees cannot be postponed. Illness cannot be postponed. If somebody needs medical support, then it has to be given now, assuming they are short of insurance. So just an example. So signals are never clear in the market, and signals you have to take based on events happening much later. For example, March 2020 fall was a signal to buy because in August the market was going to recover, but you didn't know in March that the recovery will happen in August. So similarly, if the market fell, let's say a simple single share, you had let's say a Pateja forging at 290 rupees or something, you had that share and the share price fell. Was it a signal to buy or was it a signal to sell? You don't know. It's very difficult to say. For example, the share price fell, and I don't think it is even listed now. Silverline fell from 1300 to 30 and to 6. That's it. End of story. That company never recovered. But in a portfolio, that may not be true. You can have signals which may be right or may be wrong, but given it about 5 years, good chance that it will recover. So the market fell, you thought it was buy on dips market, so you bought, and the market fell further and you bought more. It doesn't matter, because over a 4-5 year period, the market is likely to recover, and then you would make money. That is true only in case of a portfolio being managed by a portfolio manager. It's not true if it's your portfolio and it is not a very scientifically built portfolio, right? So this is what Jason Zweig says. So again, this 5-year theory belongs to Morgan Housel. Morgan Housel says give yourself 5 years, because in 5 years things will get corrected. Even COVID got corrected in 5 years. Actually, it got corrected in 3 months, but we never knew that it will get corrected in 3 months. So that is also not exactly right to say that over 5 years it will get corrected. Sometimes it might get corrected earlier, and you may run out of patience. That is the other possibility. That brings us back to another guru, that is Peter Lynch. And Peter Lynch says this is a good time to be looking at your portfolio and deciding what to do. Since I want to use the exact words which Peter Lynch uses, this is a time when you should look at your portfolio and decide that why is the share there itself? Should this share be there in your portfolio or no? Is it a share which you are, why did you buy that share? For example, I bought, I'm going to give one example of Indigo. Let me tell you, Indigo is not paying me to use that as an example. I use that airline and I use that share both. Not very happy as a flyer, but reasonably happy, or actually very happy as a shareholder. I started buying the share in March 2020, and at 800 rupees. That is perhaps the best price that I got for the share, and after that I've been buying only at higher prices. I've even bought it recently at about 4,100, 4,200. So why is that share there in my portfolio? Because it's a good company, it is building up market share, it has got 65% market share. Newer entrants will take a very long time to build, and that company has to be sleeping to let others build. So good market share. This quarter results will be fantastic thanks to Kumbh Mela. So there is logic for that share to be there in my portfolio, and therefore now with Trump tariff tantrums, I did not even hesitate whether that share should be there in my portfolio. In fact, I was more than willing to buy, and I think I bought it 4,700 or something like that the day the market fell. But it didn't. This share didn't fall much because people know that the current results would be good. So also understand that markets what do in a year, and the same thing they can also do in a day. For example, American markets give about 10% return over a century, right? Over 100 years, annual the CAGR including dividends is about 10.3%. But on April 3rd and April 4th, the S&P fell 10.5%, and next day it recovered 9.5% again to dive down the third day, right? So the market, when market gives this signal, what is it, a buy signal or is it a sell signal? So that you don't know. And when such things happen, your human brain obviously does not know how to react, so it reacts in panic and says, let's just get out and get into debt instruments. What is the need to be in equity? Which is fair enough thing, but the question is, such drastic changes is the reason why you have good returns in equity, right? If you were to get straightforward 7% return like PPF, then that it would be PPF. You want 14% return, 21% return, 30% return, then you will have to also accept 0% return, 2% return, minus 4% return. These kind of things will also happen, right? So is it buying the dip? Is it buying the dip, or is it selling the rise? So let us go to Peter Lynch's 4 questions. Why do you own a share, and why do you have it, and why do you own it? Why do you continue to own it? So for me, Indigo was very clear that I like the share, I bought the share, I made money. Now there is that bias also. So I'm holding with it. So I have absolutely no problem. And also, I do think it's very important that if you want to panic, you have to panic very quickly and panic methodically, right? So there will be some shares which you have no clue and why you have it in your portfolio. Sometimes in a portfolio you've already got 20% CAGR over the last 5-6 years. Then you're saying, okay, I think the best is over, so let me get out of the share. So it has to be a methodical getting out rather than a market-related Trump tantrum getting out, right? So why, you can even go to the basic question saying, why do you own equity at all? Why are you're 70 years of age, why don't you go into index funds? Why do you want to still look at individual stocks? That's a good question to ask. But are you in the market to benefit from the stability of let's put it this way: when you bought a share and the company had a factory in China and a factory in Vietnam, factory in India and a factory in Europe, did you think that you are buying the share because the company is manufacturing outside? No, you thought the company has a good brand, it is based in US, it is getting US it is getting US PE, and therefore you are buying. And it also has an Indian subsidiary which is getting a substantially higher PE. So you are really in a conflict whether you should buy the Indian subsidiary or whether you should use the LRS and buy the American company. So but you bought the Indian company and you're holding and you're making money, so that's good enough reason. So therefore you own that stock. Long term growth is good, long term growth in US is good, long term growth in China, I mean manufacturing in China is good, and therefore you own the share. You did not think the trade agreements between countries is going to be important. Face it, we didn't know till Trump tantrum came that he is going to use the trade tariff agreement as a weaponizing tool. So next question is, what has changed? What has changed for Indigo? Oil prices are cheaper. More and more people are flying. More and more airports are getting built. More and more aircrafts are being bought. And I can't see any reason why prices should go down. The other way to look at it is to say everything is going right, therefore it is at its highest PE, and therefore it could go down, right? So both, like I said, signals, red signal means go and green signal means stop. Then question is what to do with such what do you do with such signals, because the signals are pretty useless for you. Another question to ask is, if you did not own this share at all, will you buy this share? Will I buy all my Indigo at 5,000? I don't think so. I will wait for the current quarterly results, and when the results are good and people go and buy, maybe that's the time for me to sell. So we also have another problem called anchoring. So will I wait for the price of Indigo to go to 800? And I think that would be pretty foolish. Do I think 5,000 is at a high? I think 5,000 is really at a high, because that is its historical high. Now, if I look at it from 2025 point of view, I think 5,000 is high. If I look at it from 2035 point of view, I think 5,000 is a good buy. So therefore, for me, the point of view, when am I looking at it, that is very important. And I also have to worry about anchoring, right? So as an investor, what all should you be worried about? You should be worried about these things, especially if you have a equity portfolio. If you have a mutual fund portfolio, I don't think you need to worry about these temporary 1-day dips and 2-day dips and 6-day dips. You just don't have to worry. The market will go up, market will go down, but in the long run, equity funds, well managed equity funds by good fund managers will do well. And please think in pockets of at least 3 to 5 years, if not 10 years. If you're looking at all this whole index from a 10-year point of view, I can assure you the market will be, let's say the index today is 72,000 or 73,000. 10 years from now, can you expect it to be at 1.5 lakhs? My bet is it will definitely be more than 1.5 lakhs. So take your bets accordingly. Thank you.